All right, we'll go ahead and get started. Welcome to our webinar, and thank you for your attendance. My name is John Russon. I'm one of the partners at Pension Assurance. You'll hear from Nathan Johnston shortly. He's one of the other partners we'll be presenting to you today. We do have the ability to answer questions. We're going to get through a lot of material in 45 minutes because we don't want to take up any more of your time. But you can go ahead and ask questions. If we can get to them, we will. If not, you'll have our contact information. Feel free to reach out to us with any specific questions that you may have. We want to answer all the questions to help you feel better prepared for your plan audit. So quick introduction on Pension Assurance. We started the firm back in November 1st, 2014, so just over 3 years ago. The practice has been around for quite a while, since 2005, and it's just kind of before it was part of the typical full service accounting firm model where, you know, we had a benefit plan audit practice, and that's what we did for part of the year. In 2014, we decided to change that model and actually make it the sole focus of the firm, and therefore creating Pension Assurance. We had 125 audits at the time, and we decided that we wanted to focus on retirement plans year-round and firm-wide. So now we're up over 300 plan audits, so we've had some exciting growth, and we attribute a lot of that to just our focus on sorry for that, there's the slide. We attribute that to our focus is specifically on retirement plans and the attention that we give to that.
And good morning, everyone. I'm Nathan, and I'm going to just give you a little roadmap of what we're planning to look at today, and also kind of remind you that if you have questions at any point, go ahead and you know, raise your hand, and we can try to answer your questions. So today we're going to just talk about, you know, how this audit requirement even comes about for you. When exactly is it needed? We're going to talk a little bit about the process of selecting a plan auditor, especially if you're doing it for the first time. It would be helpful to have an idea of, you know, what kind of considerations are important in selecting a plan auditor. And then we'll talk a lot about the audit itself. Just what kind of documentation are you going to have to provide during the audit? How can your service providers help? If you've got a record keeper or a third-party administrator, how can they help you? Financial advisor, and then kind of the audit timeline. So, you know, sometimes the big question is, how did this happen? How did I end up getting into this audit requirement? And the audit requirement is under ERISA, and so it's legally required for plans that are considered to be large plans. And this all hinges on your beginning of year participant count. And generally, you're considered to be a large plan if you have more than 100 participants, and you are then expected to comply with the audit requirement if you're a large plan. Now, there's a little confusion sometimes about what exactly is a participant, because a lot of times you'll have a certain number of people that are actually contributing to the plan, and that may be a much smaller number than the number of people that you have employed who could potentially contribute to the plan. So what the Department of Labor considers to be a participant starts with the count of all of your active employees who are eligible to contribute. So that's whether or not they're actually contributing or receiving a contribution. If they're simply eligible to contribute, then they are considered to be a participant. Basically, if you take that number and you add the number of terminated participants that still have an account balance in the plan, that's about your participant count. So if that number is above 100 at the beginning of the year, you're probably expected to be under the audit. Now, there's an 80-120 rule, and what that does is it basically allows you a little bit of a buffer if you're a growing company. It gives you a little bit of a buffer as far as kind of holding off having to do the audit. And so a lot of you I know on the call are in the situation that you've just broken actually the 120 mark. And so the way the 80-120 rule works is basically if you have between 80 and 120 participants, you can look back to your prior year status and file that same status again. So I've got a couple of examples there on the slide. But if you have 118 participants, but you filed as a small plan last year, you can continue to use the small plan waiver until you break the 120 mark. Unfortunately, if you're already over that 120, you sort of have to go back under 100 again to get out of the audit requirement. This is one situation where if you're not over that 120 yet, you may look at your participant population and consider ways that you can manage that count. Sometimes you can do forced mandatory distributions to get some terminated participant balances out of the plan and things like that to try to stave off that audit requirement for a few more years. We're definitely of the mind, even though we do this for a living, that no one should do the audit if they don't really have to. So John's going to talk now about selecting an auditor.
So let's say that you've forced out all the terminated accounts and done everything you can, but you're still over the 120, so you need the audit. So that's what we'll talk about today. So the first part is selecting the auditor, which isn't as easy as it sounds. Sometimes your corporate auditor may, have the expertise and knowledge to perform the ERISA audit, and in many cases they don't. In a little bit, Nathan will talk to us about a DOL study that came out that talks about the quality of auditors' work papers and the work that they're performing. Retirement plans, they're under a lot of scrutiny. They become increasingly more technical, but not only that, there is peer reviews that look at them pretty closely, and a peer review is CPAs peer reviewing other CPAs and issuing reports. There's also the Department of Labor regularly inspects audit work papers. So that's all those have put a lot of pressure on the retirement plan audit, and many auditors are either getting out of the business, or if they continue, the quality might not be there. So very important to make sure that you do, and we'll in some later slides we'll share some RFP and some RFP questions you may want to ask. In addition to the most important one, which is price, right? I know that is an important question. I agree, but there are several qualitative questions you want to ask when selecting an auditor as well.
So this scary-looking chart here is a depiction of the audit quality studies that the Department of Labor has done over the years, and this is covering just the audit of employee benefit plans. So most of these are going to be things like 401k plans or profit-sharing plans, maybe some 403bs, but most of these are going to be the type of plans that you sponsor. And they've looked at in these different years here, 88, 97, 04, and most recently in 2014, they looked at the Form 5500 filings, and they did a pretty significant sampling of those filings where they actually went and reviewed the work done. And they found in the last study that 39% of the audits they sampled, nearly 2 out of every 5, had a major deficiency in it based on the auditing standards that we're supposed to follow as auditors. The next chart kind of shows how that breaks down in terms of, the audit quality study, which you can actually find online, and is actually kind of an interesting thing to read, even if you just kind of go through looking at the different charts. But the DOL tried to slice the data a bunch of different ways to see if they found any correlations between certain features of firms and the quality of the work that they were doing. And what they found is that, in fact, quantity is quality in this sort of arena, that, specialization significantly improves the quality of the audits that firms are performing. And so you can see here that there's a pretty big drop-off. If you look at the left column there is the number of plans that these firms are auditing, there's a pretty big drop-off once you go under 100. And so it just shows the benefit and the importance of having an auditor that is familiar with the specialized world of employee benefit plans. These plan audits are not usually the biggest revenue source for a firm. They are smaller in scope. It's not like auditing a company. And so a lot of times they're not taken as seriously as maybe a big corporate audit. But that's kind of a dangerous thing to do because there are so many specialized little areas. For instance, the definition of compensation in the plans, which we'll talk about in a bit, can be a really big problem for plans if it's not caught, and can lead to some significant and expensive corrections for the plans. And so it's important to have an auditor who works around employee benefit plans enough that they have the experience to know where the really big risk areas are. And that tends to be in firms that are auditing more than 100 plans a year. That's just based on the DOL's statistics.
Nathan, we had a question I just want to answer real quick. It was a great question about conflict of interest, independence, which is taken very seriously in our profession. And the question was, can the corporate CPA perform the ERISA audit? Just to make sure I understand the question, I'm going to kind of answer in a couple of different ways. If the corporate CPA is performing an audit for the corporation, then yes, they are independent. There's no conflict of interest. They can perform the ERISA audit or the retirement plan audit as well. In that case, that's kind of where we talk about just make sure that that's also something they are trained in as well. But there is no conflict. If the corporate CPA is performing some kind of management consulting services, there very well could be a conflict regarding their independence. So the AICPA establishes independence rules for CPAs, and the CPAs are well aware of these. So the CPA should be able to direct you on whether or not they can perform that. If they're performing any kind of management functions of the company, then that's a key indicator that they're not independent. Or if they have any ownership of the company, that'd be another area where they wouldn't be independent.
All right, and so on this slide, I kind of want to just talk for a couple minutes on just, in a way, you could think about audit deficiencies and think, well, that's a problem of the audit firm. Why is that my problem as the plan sponsor? I need to get this report signed so I can do my filings, but if they're putting their name on it and they're not actually doing a good job, how does that really impact me? And so there's a few possible ways that can impact you. One is we have seen situations where the Form 5500 was rejected because it was determined that the audit work was so deficient that it was in essence like an audit hadn't been done at all. And that actually came up in a recent experience with a new client that we picked up. We were looking at their prior year filings, and there were lots of things that were quite questionable about them. And in fact, the year before we started doing the audit, that filing ended up being rejected, and so we ended up the client had to pay us to do that audit as well. So certainly in those egregious situations, you're gonna be in a position where the DOL might reject the filing. The DOL has also expressed a lot of interest in, they're looking at every way they can to improve audit deficiencies. And the first thing they've done is crack down on us, those of us who are in the plan auditing community. They've cracked down on the people who review us. And so that's the kind of the peer review process where CPA firms review other CPA firms. They've also begun sampling work that firms are doing on an annual basis. So, about every year we get about 2 audits selected that DOL inspects of ours. And what they want to do next is they want to really turn the screws on plan administrators like yourselves and really make it more as part of your fiduciary responsibility to prudently choose an auditor. And I think that's coming down the pipeline. And so those are a few things from the regulatory side. There's also, something to consider, which I was kind of mentioning a moment ago, is that, if an auditor is not really experienced, they may not be able to find everything that you really need them to find so that you keep your plan compliant. And I can't tell you how many times we've taken over an audit and found an issue that had never been detected before by the predecessor, and that ends up going back many years and becomes an expensive correction. So that's something to consider when you're doing the cost-benefit analysis. There's certainly some very cheap audits out there. Most of the time I find that the cheapest of the cheap are with auditors that probably are not doing the best work. That doesn't mean you should get an expensive audit or that your audit has to be expensive, but you should probably be suspicious of the big outliers in terms of cost, and do your due diligence to make sure that it's not going to cost you more money down the road.
One thing I'd like to point out is sometimes when I'm having conversations with the plan sponsor and they're asking me how I know so much information about their plan, and a lot of people know this, is the Form 5500 and the audited financial statements are publicly available. If you were to ask me to pull Apple's 10K filing and Apple's retirement plan financials, I could get to Apple's retirement plan financials a lot quicker than I could their 10K filing. They're just that easy to access for the public. So whether that's, attorneys looking through that, or whether it's, DOL or whoever, they're out there for the world to see.
All right, well, let's move out of the scary world of the Department of Labor Audit Quality Study, and let's just talk about, what are some things that you should consider in hiring an auditor. And as sort of an overarching idea here, one thing that you want to do is I highly recommend that you document your decision. ERISA, which kind of oversees all of these audits and everything you do with your retirement plan, really is a process-oriented law. And so if you can document your processes, you can substantiate the decisions that you've made as a plan administrator or another fiduciary on the plan, or as just plan management, that is in your best interest to showing compliance. So here are some key questions you want to ask. You want to ask certainly the number and types of plans that the CPA audits. Do they audit a lot of these? Do they audit your type of plan? How much plan-specific training does the CPA have? Another big question is what percentage of the firm's revenue comes from employee benefit plans? If it's not an important revenue center for the firm, they're not going to be likely to prioritize the quality of the audits they're performing. Another thing that you might not think of, especially if you're new to the audit requirement and audit world, is you actually want to ask who's going to work on your audit. Because you might be working with someone, kind of a senior personnel that does have a lot of employee benefit plan experience, but then when it comes to doing the audit, you might be getting a first-year staff auditor fresh out of college who, can barely get debits and credits right, let alone, understand the nuances of 401k contributions and definitions of compensation and so on and so forth. And so it's always a good question to ask, who is going to work on my audit? What's that team going to look at? And there's a few other things, membership in audit quality centers at the AICPA that are specialized in benefit plans. And of course, you want to ask some key questions about their standings with the state boards and the regulators. And finally, you certainly want to look at the fees and do a good comparison on a holistic basis of, are you getting good value for the fee? There's a word you might hear tossed around called, we call a term, it's limited scope audits. And a lot of times we get questions about what is a limited scope audit? What does it mean? Why do we have that? In the auditing world, what it just means is that we're doing less work than we normally would. And this is because of something that the Department of Labor allows, where if you have your investments at a qualified bank, trust company, or an insurance company, and they're willing to provide a complete and accurate certification, so it's kind of what we call it. It's sort of a document that attests that the information that they provided, the valuations on the investments, the gains and losses and interest income and so on that they've reported in there is complete and accurate. And if we have that, then we're allowed as auditors to sort of set aside the testing of those investments and focus our audit on participant transactions. And that really is more of the risky area of a plan. That's really where you can find more exceptions and more problems, is when you're looking at the actual processes and transactions with contributions, with participant withdrawals, maybe vesting if you have a vesting schedule. Those are really where we tend to find problems. And so the limited scope allows us to focus on those areas. And the other benefit to plan sponsors is it helps keep audit fees down, because there's less hours required when we don't have to test all those investments.
Okay, we'll move into the actual audit itself and kind of what to expect with that. And the great thing about 401k plans is you should have a lot of support. If you don't, talk to us, we can make introductions, but you should have a good team around the plan where, you know, you've got good investment advice, you've got good administration, record keeping, you know, they're keeping you informed of everything. And then, you know, it should help you a lot. And so what we like to do in the audit is we like to leverage the service providers, and they actually don't mind it as well. I mean, they appreciate it. It makes the audit more efficient, and, you know, we tend to speak their language, and we're able to make the audit less impactful, more low impact for the plan sponsors. So the first area is the financial advisor. So you may or may not have a financial advisor. Hopefully you do. And if the way we leverage a financial advisor is we're able to, from them, we're able to get like investment policy statements, plan committee meeting minutes, and just kind of look at some of that plan governance that we, you know, kind of look at during the audit. Make sure that, you know, the plan is, you know, there's somebody, the plan sponsor or a committee that's reviewing the service provider's investment performance, keeping up to date, and making sure that the plan is in compliance. And so we'll lean on the financial advisors to help us with that. Next is the TPA. So if you have an unbundled solution, so you have a separate third-party administrator, they're able to provide a lot of documents directly to us, which would be like the plan documents, you know, IRS opinion letter, summary plan description, some of those kind of plan design and kind of the legal documents of the plan. And then also with an unbundled solution, the TPAs will also prepare the Form 5500 and non-discrim test. So we get that from them. The record keeper and custodian, this has been a great evolution over the last 10, 15 years, is just the way that their websites have become very accessible for auditors. So as an auditor, what we do is we'll get auditor access to the record keeper's website, and all the big record keepers have this readily available. They all do a pretty good job of getting us a good audit package. So I would say, you know, 90% of the reports we need come directly from the record keeper, from the service provider, and we're able to go in and pull those instead of having to drag, you know, the client through that. All the data requests, document requests, we're able to pull those directly from the record keeper. This makes the audit more efficient, and it gives us real-time access to reports. So if you do end up with not getting the online access or not aware of that, you know, you should make them aware of it and have them use that. It will save everybody a lot of time. And then the plan sponsor, as I kind of said, we like to make this a low-impact audit. We still want to make it very educational, and, you know, we want you as a plan sponsor to walk away from it feeling more educated about your plan, better understanding of the plan document and the provisions, and better understanding of the processes and the internal controls around those processes. But as far as the document requests, we don't have too many from a plan sponsor, and that's just because a lot of the transactions and documents around the retirement plan are available through third-party service providers. But we do ask for a few, and I'll go through those on the next couple of slides. I'm going to go through these documents and kind of touch on each one so you have an understanding, because this is kind of how the audit gets going, is these document requests from the auditor. And if you understand what they are, it makes the communication a lot easier going through the audit because you're familiar with what they want. Okay, so here is our version. Well, it's our what we call PDC schedule, and that's prepared by client. And this is our version of it. Pretty similar. It's pretty universal. Every audit firm might have a slightly, you know, differing one, but this is kind of the meat right here. So the first set of documents we need are kind of, we start with the legal documents. How is the plan set up? Let's look at the plan document. The most recent one, anyone applicable for any of the periods we're covering. If there's any document, we'll need those as well. We'll need the IRS determination letter or opinion letter. The IRS determination letter is specific to the one plan document. So if you have like an attorney draft a plan document for you, specific for your plan, then we'd be looking for an IRS determination letter if that's been applied for. If it's not, then you can either apply for it or we can work around it. The opinion letter is going to be for if you've got kind of a prototype plan document where you adopted agreement, which is majority of what's out there. The IRS will issue an opinion letter on that plan document and the lead adoption agreement, and that's part of the basic plan document is what they call that. Meeting minutes. So here, the auditor, what we're looking for is, hopefully there's a plan committee with some meeting minutes. If not, maybe there's board or director meeting minutes that discuss the plan. If not, that's okay. That we run into that quite a bit as well. We just make the recommendation to document something, as we kind of alluded to earlier. Do stance on documenting, fiduciary practices, meeting minutes. So they want to see it. So we like to see it, and we like to make a recommendation to have it, just in case you do have a regulator visit from DOL or IRS. That might be something they want to see as well. Summary plan description, we get a copy of that just mainly to kind of make sure it lines up with the plan document, because that's what's being communicated to all the participants, and it's required that every participant have access to the summary plan description. And that's kind of the easier to read version of the plan document that talks about the provisions of the plan. So we like to get a copy of that as well. The next two, they're available online. And a lot of the people on this call are probably brand new to the large plan audit space. So there may probably not a prior year financial statements, but there will be a prior year 5500. So we go on eFast and we pull that 5500. If it was audited last year, then we could pull that audit will be attached to that Form 5500 filing. Moving on down, the non-discrimination test. So that's part of our audit, and it's an area where we actually find some issues sometimes. And I think the reason for that is sometimes the service providers will have in their agreement, hey, you provide us a census, the census report, and we're going to put it in our system and software, and we're going to run the non-discrim test. And there could be a disconnect if that census is accurate, and so the plan sponsor might think the service provider is kind of doing a review on that, and vice versa. The service provider might think the plan sponsor scrubbed it. So and making sure that you're submitting complete and accurate census information, so that can go to be processed into the non-discrimination test. Everybody should be familiar with those. If you have a safe harbor plan, you're not running as many tests, but some of you are probably very used to it because all the highly compensated employees are getting refunds every year. It just really depends on the demographics of the company and how those tests, if they're passed or they're failed. Next one is the schedule of deposits. That's kind of the one document we ask the clients to prepare. It's a one-page Excel sheet, not very complicated, plan level. We just want to look at the deposits into the plan, the dollar amounts, and the timing of those deposits. And we'll talk about it in a little bit. That's one of the biggest findings we have, but it's really one of the biggest findings the Department of Labor looks for. So we're, want to make sure we have tests that can find that and we can address it before you have a Department of Labor inspection, and so that you can get the process fixed, put good controls in place, and make sure that contributions are made timely to the plan. So that's part of our audit, is we ask for that one-page deposit schedule. Copy of the fidelity bond or crime policy with a risk endorsement. A lot of times we are given the fiduciary liability insurance coverage. We don't want that. That covers the fiduciaries of the plan. It's not what we're looking for. In this case, we're looking for the bond or the insurance policy that covers the assets of the plan. And so that's done in one of two ways. It's either a fidelity bond specific to the plan, or it's going to be the company crime policy, and it's going to have a risk endorsement. And what the risk endorsement does is basically waives the deductible for any ERISA-related claims on the retirement plan. The next one is, we always kind of, get questioned on this one. Why are you looking at, 2018 statements if it's a 2017 audit? We're required to look at subsequent activity up through the date of our audit report. So first quarter, sometimes the second quarter, sometimes the third quarter, depending how late, things get moving on the audit. But we do need to look at subsequent activity just to make sure to see if there's any accruals we need to book or any activity we need to be aware of to either record or disclose in the footnotes. Last one is the Form 5500. That we don't need that up front. That's one we need. We audit independent of the Form 5500 and Schedule H, and then at the end we reconcile to the Schedule H. If the numbers don't tie out, we have to do a reconciliation and include that in the footnotes. Some service providers will just change the Form 5500 to match the audit, but that's all kind of handled at the end. Any questions? No? Okay. The next section is what we refer to as the audit package. And this comes from the record keeper, from the company who's handling those, transactions and the money movement and the custodian of the assets. So the first document we're looking for is a certification letter or complete and accurate certification, and that's really what triggers that limited scope that Nathan talked about earlier. And as he said, that's a qualified institution that's able to certify those assets. Once we get that letter, we're allowed to rely on all their statements they provide us as far as the valuations and the earnings. So we're looking for that. Most of the audits are limited scope. If the assets aren't being held at a qualified institution, it's probably something you want to look at as a plan committee and see if you need to make a change. Being a limited scope is actually more acceptable, or I would say raises less flags if you qualify for the limited scope audit. And I think 90–95% of plans do qualify for that. Number 9 is plan statements, so just plan level statements. Those kind of build out the financial statements, which is ultimately what we issue, right? We're issuing financial statements with footnotes, and that all gets driven off of the plan level statements. But in our audit, we also have to look at some of the compliance with the plan document and some of the participant level transactions and activity. And so we need a participant detail report, and that will line out, all the participants, their beginning balance, their activity, and their ending balance. And from there, we'll do some test work. Loans, if your plan has loans, that's something we'll have to look at. That's a participant-initiated transaction, so we have to look at that. Same goes with distributions. We have to look at some distributions as well and include those in our test work. And a lot of times, those are the reports that allow auditors to make our selections of what we want to test. But a lot of these documents, once we get into the test work, are actually paperless. A lot of it's done online. So there's various ways to audit these, and it's case by case. But it could be paper form, withdrawal request. It could be a canceled check. It could be 1099-R. So there's a few different ways. There's a question about the prior year 5500. Yeah, so when we do an audit, we do need to look at the prior year 5500 filing as well as the current year, just to make sure everything rolls forward. So hopefully that answered it. If it didn't, if you do have a follow-up question on that, go ahead and email us and we can specifically address that question. And then the last one on here is just the SSA 16 report, more commonly referred to as the SOC 1, previously known as the SAS 70. And that's a report on the service provider that talks about, it's where they have to hire a CPA firm to go in and review their processes and controls around the services they provide. And then they issue that report. And then as auditors on the user end, where we're auditing the companies using those services from those service providers, we rely on that SOC 1 report to document some internal controls and even minimize some of our testing. And then once we get into test work or field work, it says field work, it can be performed remotely or it can be performed on site. We'll look at a couple of payroll registers and some bank statements that we'll sample for part of our test work. I just want one slide on the deposit schedule, because that is the only document that the client has to produce. This is it. It's a one-page Excel, paycheck date, deposits, deposit date, the variances. Let's explain those. And it's really just looking at the timeliness of contributions, which is, one of the biggest findings. So next, Nathan will actually talk to us about the findings.
Yeah. So this is the part where you might want to pay attention. This is what I call kind of the answers to the test, and just kind of talk through a few of the common audit findings we have, and also kind of mention a few things that you can do to try to not have that be an audit finding for you and your plan. Of course, you can't necessarily change the past. Us auditors are always looking into the past, but these are things that, the good thing is that almost everything in a plan is correctable. And so it's good to, as soon as you find an issue, to just correct it and try to keep the plan compliant going forward. So the most common one really is what are known as late contributions or late remittances. The whole idea here is that when the pay date happens, and so your employees get their paychecks, there's an amount that, if they're contributing to, say, the 401k plan, there's an amount that is withheld from their paycheck that is supposed to be their retirement plan contribution. And so on that date, those contributions are considered to be plan assets. And the idea then is that if there's a long period of time between the pay date and the date that that money is invested in the participant's account, then there is a prohibited transaction, which is the plan sponsor, the company, is borrowing from the participants. And so that's how ERISA views that type of thing. That's how the DOL views it. And so the idea is that, as soon as that pay date happens, you want to do your best to get that money into the plan as quickly as possible. If you're a small plan before, you might have been familiar with the 7-day safe harbor. And what that was is if you got those contributions within 7 days, then it's deemed to be timely. In the large plan world, that becomes a much more subjective thing, where a lot of times a DOL auditor will be holding you to a period of time that's going to be much less than that 7 days. Usually something like 3 to 4 days is what we see often. And so it's also going to be based largely on your remittance pattern. So a lot of times what they'll do is they'll look at your something like that deposit schedule John just showed, and they'll say, hey, you got it in 4 days this time back in December. How come you got it in 8 days in January and 12 days in February, and so on and so forth? And they'll basically use that shorter contribution period to establish that, hey, you've shown that it's administratively feasible for you to make these contributions in this particular time period, and so anything beyond that is late. And that usually is roughly how they view that type of thing. And so a couple of things you want to do is, one is you want to just have a process that makes your contribution remittances a very consistent thing. A lot of times the best run plans, they submit on the pay date, or they might submit on the Thursday after the pay date, or whatever it is. But having a regular process is one of the best things you can do to make sure that you don't have late contributions as a large plan. The second thing is not following the terms of the plan document. If you're involved in plan operations, particularly if you're the plan administrator, you definitely want to make sure you're familiar with the terms of your plan document. And the reason for that is that the whole premise of the tax qualification of the plan is based on that document. And so the idea behind the IRS opinion letter is that as long as you're following this document, then you're going to receive all of the tax qualified benefits of this plan. But if you're not following the plan, then you sort of don't have that leg to stand on anymore. And so the idea is that, it seems kind of ticky-tack to have to follow all of these rules to the T, but the idea is that that's the premise of the tax qualification. And so the big ones are definitely the definition of plan compensation. One question that you should have answered, if you don't know the answer now, you should find out almost as soon as you get off this call. What is the definition of planned compensation? Specifically, do we include or exclude bonuses for contributions? This is one of the most common errors we see, and also potentially one of the most expensive. If your plan says doesn't have a specific exclusion for bonuses, but actually in practice you're excluding bonuses when you calculate contributions, that can result in missed contributions, which can lead to some corrections. And if you give a lot of bonuses, that can be an expensive correction. So definitely something to make sure that your plan compensation that you're actually using in payroll is the same thing you're using that follows your plan document. You also want to make sure you understand what your eligibility periods are. You want to make sure that your vesting schedule, that you understand it, and the vesting is being calculated correctly on participant distributions. The third one is basically just anytime you receive instructions from participants, you want to make sure that that's followed in a timely manner, and that you have sort of processes in place to make sure that those are handled, especially in kind of this paperless environment where a lot of times you might not have the participant going to you and saying, hey, I want to increase my deferral. They might be going on to a website, and then there's a report that you get where you're supposed to make sure that you're updating things. You want to just make sure that you have a process in place there. And the last one is just if you have auto enrollment is a great feature that a lot of plans are starting to have. It's an important part of helping participants be retirement ready, but it does come with a risk, which is if you miss someone, you don't enroll someone in the plan and they haven't opted out, that can be something that requires a correction and requires the employer to make contributions to the plan. And so you definitely want to make sure you have a process to make sure you're timely auto-enrolling everyone who's eligible.
Perfect. So now let's talk audit timeline and deadlines. And I'll make this brief. I know we're almost out of time here. Everybody should be familiar with the deadline because it's the same deadlines of the July 31st deadline for the Form 5500 filing, and then you have the 2.5-month extension till October 15th for a calendar year plan. So be aware of those deadlines. The audit timeline for us, we usually plan on about 6 weeks, start to finish. It doesn't take 6 weeks worth of hours. It's a nice, efficient audit, and it's kind of low impact to everybody involved. So the way that usually plays out is the clock starts ticking once we get an audit package. So once we get that audit package, we'll go through that. We'll send out selections. We'll run some analyticals and other things first, and then we'll send out selections and try to schedule a date for test work or field work. Usually give you a couple weeks to plan for that and find something in the calendar that works. In the meanwhile, we're still working on a lot of the audit in our office, just kind of moving along, getting the work papers ready, getting ready for test work. Once we do test work, as I mentioned before, we can do it remotely. We can do it on site. We send a list of the documents we need to see, which are primarily payroll registers and bank statements at this point. A lot of the enrollment forms have now gone paperless. If we were to perform it remotely, then we set up a secured shared folder. We exchange documents back and forth that way, and then we schedule a call that's anywhere from 45 minutes to an hour typically. And that's a conversation we have with the process owners of the plan, and that's where we talk through all the processes around the 401k plan. We discuss controls around those processes. We document those as part of auditing standards. There's also a great opportunity for us to look at those processes and make recommendations and advise on best practices. We audit over 300 plans, so we see a lot of what's out there, and a lot of, even specific to your service provider or even industry, we've probably got multiple clients that we can pull that knowledge from and share during that conversation. After that, then we wrap up our documentation. We have a couple-step review process, and then we produce a draft of the financial statements. That's a thing to note in the 401k world. It's pretty common that the auditor will draft those financial statements. There is some additional language in an engagement letter where we carve that out as what they call a non-attest service. So it requires some oversight from a client, from a plan sponsor. But we do draft the financials, then we turn them over to the plan sponsor, and as long as you've got the skills, knowledge, and experience, you'll take ownership of those and approve them, and then we issue the financial statements. And the final issue financial statements is just a PDF document that you attach to your Form 5500 filing, and away you go. So we're out of time. The last two slides are just a commercial that talks about us and says how great we are and all that stuff. But we're available if you have any questions. If you want to follow up with questions, if you'd like a proposal from us, we're happy to provide one. As we mentioned, it's always good to get a couple proposals and do some kind of due diligence process on that decision. But we are out of time, so we'll let everybody go about their day. And thank you so much for attending our webinar.